All right. Good afternoon, everyone. I want to say thank you for the time and the opportunity to talk with you guys today. And as you know, for those who have come every Thursday, we have trainings like this on product sales ideas every Thursday at 4 o'clock Central. The idea is how can we help ourselves improve in the industry, understanding different types of opportunities that are out there. Being that I've done this for 18 plus years, my goal and objective is to help people grow. And if you find the valor value proposition, there's always room for more. We got about 500 agents across the country and willing to serve and help anyone that I can. So I appreciate the opportunity to talk to you guys today. If you don't see the whole thing, have to drop off early, or if you're watching this for the first time on the YouTube channel, we do have all of our trainings set up on the YouTube channel. So at Valor Financial, you'll be able to see all of these trainings and then some. There's just a lot on there, a lot of content. What I wanted to do today is focus my efforts here on education of understanding whole life insurance. Um, for those who don't know, in the 18 years I've been doing this, 7 years I actually worked for MetLife, and I would sell whole life to financial advisors to sell to their clients. And when I was selling that, that was the time when guaranteed universal life was very popular. So you're talking about one of the cheapest permanent insurance products at the time compared to one of the most expensive. And we had to come up with sales ideas and ways that we could help people utilize whole life versus GUL or VUL even with their clients. So we do a lot of point of sale, a lot of story selling. But when you talk about whole life, a lot of people nowadays have got on the IUL train because they want to use that product, and which is fine. Here at Valor, we have whole life and IULs, but a lot of times people will just sell IULs because they don't have access to whole life. So immediately when you think of whole life, it's suddenly the devil or a bad product because you don't have access to it and you want to make a sale. So, what we want to do today is truly understand from an objective point of view whole life insurance, how people position it, how it's sold, and then ultimately you can make your own executive decision. I'm not here to tell you what's best for your client, but what I will say is that if you want to show them different options, we'll uncover what type of clients this might make sense for. And it is positioned as you see, right here. A lot of people will say it is one of the greatest non-market correlated assets that you can actually own. Why is that important? When you think right off the bat, clients have a lot of their assets invested in the market. You want a more conservative side. So when you think about that, is that whole life part the conservative side? So therein lies the question, and we'll let the results speak for themselves. So the agenda for today, we're going to talk about whole life insurance, just a general overview. We'll talk about some of the key components and features of it, including dividend options, some exit strategies for whole life policies we call non-forfeiture options. We'll go over a little bit on infinite banking and some examples as well to just give you a general overview of what whole life is. And again, any questions along the way, feel free to put your little emoji hand up, or I'll check down here for the chat sometimes to see if a chat question comes in without me seeing it. So let's dive right in and talk about what is whole life insurance. So whole life insurance is permanent insurance. A lot of times when you talk to customers, they're ignorant on the fact that whole life insurance, um, you know, they'll say whole life insurance. I want to buy whole life insurance when they mean permanent insurance. So you have to make that distinguished difference as to, well, do you mean the product whole life, or do you mean permanent insurance that will last you your entire life? So whole life is a type of permanent insurance with some major key components are guaranteed death benefit. Okay. No thought process. You'll see right here the asterisk. As long as the client pays that premium for the specified duration, that policy is guaranteed. And we'll talk about why someone would or wouldn't in the future conversations, because again, what we'll talk about too is in this presentation is the mistakes that even some of the whole life agents make because all they sell is whole life. So we want to overcome those scenarios or just have an educated conversation around product, not around opinions. So guaranteed death benefit. They are the company that has guaranteed level, or product, I should say, guaranteed level premiums that will never increase. Now, in the universal life chassis, the only product that can say that is as long as you pay your premiums on time is a guaranteed universal life. Anything that has a guarantee to it, as long as you pay the premium on time, then you will have a guaranteed policy for life. But a current assumption universal life, IULs under the normal pretenses, and variable products, unless you have a guaranteed rider on those, then you could have some fluctuation based on market performance or risk. So if someone over illustrates top illustration rates, and then the carrier reduces their crediting rates, you could run into a problem. You won't have that with whole life because the premiums are guaranteed to never change. And as long as you pay your premiums for that specified duration, because they make 10 pays, 12, 20 to age 65, or all pays, you will not run out of that coverage. And the big thing here is guaranteed cash value accumulation. Okay, so I want to pause there for a second because I'm sure all of us have come across an agent who has said, well, my policy is going to pay guaranteed 4% cash value growth. Now, that's actually true, but also a lie at the same time. So, uncovering the conversation piece with whole life agents, they're trying to make their product sound better than it actually is because in whole life, you're not buying dollars of coverage, you're buying units of coverage. What does that mean? Right? So you're talking about an apple and an orange. If I took a policy with an IUL out and say I took $20,000 out of the cash value of this life insurance policy, my death benefit would reduce by $20,000. It's a dollar for dollar reduction. If I had a whole life policy and I took out $20,000, I might reduce my death benefit by $23,422 or something like that because it's a different unit of measurement. So when they talk about guaranteed cash value, think of a giant clock, okay? In a clock, there's a bunch of little cogs inside of there to make it work, the cuckoo clock, for example. So that 4% is accurate, but it's just one tiny piece inside this whole clock being built for the whole life insurance. So even though there's a 4% indicator in there, it's a different unit of measurement. So you're not going to see a true 4% inside of the cash value. I will show you an example of this as we look at a Mass Mutual policy here in a minute. But just understand you're talking about apples and oranges. There are two different types of units of measurement, so they cannot be equalized the same way that some people would think they would be equalized. And the big thing is that for whole life policies to matter, to exist, you have this endowment policy. The idea of this as an endowment is that the policy's cash value will equal the initial death benefit at time of endowment. So if I were to show you that, this is the component that you would see. In this example, what you have is you have a situation where a client who is 35 years old, preferred plus non-tobacco, is paying $65.25 in annual premium. Well, over time, this guaranteed death benefit is going to grow the cash value here. We're not talking about anything else right now. We're just talking about the base policy and the cash value growth inside of it. So it starts out at zero, but then by the age of 95, you'll see that the cash value guaranteed is $500,000. So from 35 to age 95, this client is paying 65.25 per year. And at the age of 95, when the policy endows, that means the client will guaranteed have $500,000 in cash value inside of this policy. And in the olden days, that meant that the policy was no longer active. The client would actually get all their money back, and because they beat the system, so to speak. That's the idea behind these endowment features, is that you basically get your money back because there's no more net amount at risk for the customer. They already have, all the cash value inside the policy. So that's the idea behind endowment. Now, there's going to be an extra shade to this that we'll talk about in a minute, but just again, talking about the components in a deeper level for, the three main things. We're going to talk about death benefit, guaranteed payout to beneficiaries. So there's no questions, no rhyme or reason, no like justification or anything. You have a guaranteed payout to beneficiaries. It is income tax free, just like any life insurance, and can be level or it can be increasing. We'll talk about that in a little bit. And then we have a typo, a CA value, or cash value, what it should be. So that'll be fixed. But cash value does build equity inside the policy. So again, when you talk to a whole life expert or someone just talking about whole life, they will talk about this as a non-market correlated asset. It's going to grow no matter what the market does because of the fact that it is dictated by the mutual company. It grows tax deferred, and you can take out loans or withdrawals on the cash value of these whole life policies, which again can be a misnomer because a lot of people will say that one phrase that like haunts my mind, that the cash value doesn't belong to you. You could technically say the same thing with a level death benefit IUL. So you have to understand the differences. You can use cash while alive, death benefit at death, but depending on how you use it, it will dictate what your death benefit is. So, understand that it's the way that the cash grows dictates how the policy will pay out. So I always try and tell people, get that vernacular out of your your verbiage out of your vernacular. I think just get it out of your system, because basically the idea there is, because if you talk to someone else and they're like, you can take loans out of whole life and use it for cash value for retirement, now all of a sudden everything you said is shot. So just understanding the differences in how it's accessible and what you can use it for. There is a difference with loans and provisions for sure, but that's more of an in-depth conversation that we'll probably talk about later. Again, premiums are level for the entire life, and a portion of it does go to the cost of insurance, and then a portion goes to the guaranteed cash value. So that's part of how whole life works. So if we think about that, there are two different types of whole life. Okay, there is participating and there's non-participating. Okay, so two different sides of the coin. And you'll understand why most people, 99% of the time, will pick the participating, is because of these dividends. Okay, so every year you have the ability or opportunity to get dividends in your policy. So when you think about what that means, is I have a policy, let's say it's Mass Mutual, New York Life, Northwestern, Guardian. Those are the top four whole life mutual companies, right? There are other companies that sell whole life, but the ones that resonate the most are those top four. Now, when you talk about those companies, when you talk about those and the dividends, let's say, for example's sake, a year passes, it's January 1, and the company says, congratulations, we're solvent, we're still kosher, everyone gets a dividend. Now, The dividend is fantastic, but to understand what it truly is, we have to understand one thing. It is a partial refund of your own premium. Okay. So you have eligibility for dividends. The dividends are based on company performance. And usually, if you have a dividend paying whole life or participating versus a non participating, it usually costs you more, almost like an increasing IUL costs more than a level IUL. Okay. So just trying to connect the dots between the two. Okay. Non participating, almost no one buys this because there's no dividends. The premiums are slightly less. You only have your guarantees. There's no increasing, no nothing, and it's very limited in carriers. So the idea for these policies has usually been for what people call a 412(e)(3) plan, a defined contribution type plan where you can basically maximize your tax deductions, but you need guaranteed cash growth and a guaranteed death benefit. And no other product is like that except for whole life. So a lot of carriers would create these. John Hancock had one, Prudential had one. More the stock companies versus the mutual companies had these non-participating whole life products. But tried and true, participating always seems to take the cake. And we've just seen less and less or a discontinuation of the non-participating whole life. Now, there are carriers like Corebridge, for example's sake, if you bought the Select-A-Term product and you miss the conversion privileges for their what I call good products or their current portfolio, all you can convert to is a non-par whole life or a really junky IUL. So they're still in existence, but a lot of people will use them as like conversion privileges as opposed to a go forward product, which tells me that means it costs a lot more. So that's why I say most people pick participating. Now, this is kind of understanding from a slide perspective of how the dividends work, how the policy works, in a grand scheme of things. So if we look at the initial start of the policy year, client pays premium, and then charges are deducted, usually deducted on a monthly basis. So throughout the year, you're going to get these company mortality charges and expenses, and then you're going to get the credits. So once again, that cash growth, and again, they say example of 4%. 2 slides ago, remember I told you that 4% is not really 4%. It is just a piece to the overall puzzle of how to build out a whole life contract. Okay? Then at the end of the policy year, the company says, congratulations, we have a surplus. We're passing out dividends. Everybody gets dividends, and then it rinses and repeats. That's just generally how policies work. Now, dividends, just to give you an idea with dividends, that, as I mentioned, is a partial refund of your own money. Okay? So when it's a partial refund of your own money, it is considered not taxable. Okay? There's no tax to dividends. So that is a big perk. Now, the interesting thing is that they're not guaranteed. So any response you'll hear from a whole life guy is, well, yeah, they're not guaranteed, but we've never missed one in our 170 years of existence. So it's not guaranteed, but you can take it to the bank, whatever. But the fact of the matter is it's still not guaranteed. Much like market performance to an IUL is still not guaranteed. So once again, just going back and forth between the two, what are the trade-offs for one versus the trade-offs to the other? And then that leads to the question of what's best for your client. Now, the dividend options, just to give you an idea, people have several ways that you can exercise these dividends. Okay? Cash payment. So if you had a dividend of $500, you could actually take that in cash. And again, because it's a partial refund of your own premium, there are no taxes to that refund. Okay? There is premium reduction. So if my premium was $2,000 a year and then I had a dividend of 500, then I only have to send a check for 1,500 to the client, to the company, and it will reduce over time. If you pick this option, the client will end up paying for about 30 years before the policy eliminates all the premiums. Okay. Just roughly speaking, based on dividend history and performance, anytime someone puts less into a policy, there's less of a dividend given to the customer. So premium reduction is possible. The one that almost no one picks is accumulated interest. What that means is you have your bucket for your whole life policy, and those dividends they declare, you move into a separate bucket, and it'll yield a true 4% return. But that 4% return that you're getting on that money is taxable. So almost everyone that I've ever talked to in 18 years of doing this, no one has ever picked accumulated interest that I've seen. Okay. Anyone can be different, but what I've seen is not that. Paid up additions is the most popular one, so we'll talk about that in just a second here. Use the chart and everything, but 1 year term. Okay. So, in order to compete with things like GULs in the early 2000s, even IULs nowadays, what someone may do is they might do a 50-50 blend between, whole life and built in term. And what happens is the dividend will go to the term and it'll start buying out pieces of it. So now all of a sudden you'll have 55 whole life, 45 term, and it'll continue down that road until it's equalized and the dividend is higher. And then you'll see the policy increase again. So if you see a policy that's a dividend paying whole life, like a New York Life, a Northwestern, but the face amount stays at 500K the whole time, it means they've bought a split perm term combo and they're paying off the term with a dividend. Now, the paid up additions is a very crucial piece to the whole puzzle. So, what you would see is in this scenario, we have Mr. 35-year-old again paying the 65.25, and you'll see that the dividends magically give him $1 million right off the bat. What I will say in this picture is that is not accurate. Okay. The idea and the trajectory of it going up is accurate with dividends. However, the immediate one dividend will not increase you all the way up to $1 million. Okay. It might increase you to $504,000. Okay. So just don't let that $1 million piece get in the way of the conversation. What you want to see here from the paid up addition side is think of this as your base policy. Okay. 500K is your base policy. And as you see, it's static the whole way. Now, your paid up additions, what that is that is buying micro transactions. So if a premium of 65.25 bought you a typical $500,000 whole life policy, let's say you put 6,500 in as an extra premium, but in a paid up additions rider. That might only buy you, because it's paid up, it's not expecting more premium. It might only buy you, let's say, $25,000 in coverage. So there's a big discrepancy or a big difference between paid up versus your base policy. So I call this, kind of like cake. So your 500,000 is your base layer of cake. And then every year a dividend gets added. It's like adding layers on top of the cake to help this thing continue to grow. That makes sense? John, I see you. Is that a thumbs up? Can you give me a thumbs up if that makes sense? You're on mute.
Yes, Phil. You
I
got it.
said just give me a thumbs up, but I do enjoy hearing your voice, so thank you. Thank
To
you,
figure
Shawad.
out the thumbs up, I thought it's easier.
All good, my friend. So yeah, the idea is once again that you're adding layers on top of the cake. You're adding dividends, so it's increasing your policy, but your premium is not increasing. Okay, so your death benefit's growing. It's just not going to grow at a clip of what you would see with an IUL because the customer is assuming some of the risk with cash growth. Okay, this is the tortoise versus the hare. So you have to understand which one is more advantageous for your client. So let's say, for example's sake, the client is going through the product and, we'll go back here and this client at 75 cannot pay for the premiums anymore. They don't have enough money to have this policy continue. They have a few options at their fingertips called non-forfeiture options. Okay. So unlike term where you can't pay it anymore, it goes away, you have options here. So the first one is you can cash it out. Anything higher than what you put into the policy, you're going to pay taxes on that gains. You have reduced paid up. Now, this is an interesting one. So let's say, for example's sake, let's be honest, some of us here have probably tried to do a 1035 exchange to an IUL, and all of a sudden we find out our client's uninsurable. Crap. Can't do anything. Well, fact of the matter is if they have a whole life policy and they don't want to pay premium on it anymore, and they want to walk away with something as opposed to nothing at all, then you can do an RPU, a reduced paid up. You'll see it on the illustration that I'll show you as an example. But the idea really is I have a $500,000 policy. Let's say there's $100,000 in cash. The company would calculate how much death benefit they could give you guaranteed at that point and say it's like $237,000. Well, they'll give you a $237,000 guaranteed policy. You'll still get dividends and cash will still grow inside of it, just not as fast as it would be if you were funding it. But it's locked in, and the only other way you can access it is if you surrender it. Okay, can't even 1035 it. That's why it's a non-forfeiture option. Last but not least is extended term. So what they would say is in this example that we used before, 500K policy, client has 100,000 in cash. I can't afford to pay this anymore, but I need that $500,000 death benefit. The carrier will calculate how long that 500,000 with the cost of insurance on a term chassis would be, and they'll flip it to term. So, excuse me. So the client has an automatic out, same face amount that they had. They just have to figure out how long it'll last, and they'll calculate it before you make any decisions. These are all three different options available for the customer if they need an exit strategy and they want a guaranteed no more premium option.
One question, Phil, here.
Yeah, what's up?
So for reduced paid up policy or extended term, in those options, do the client has to do that medical test again or no? No
Nope,
medical test, right?
no medical test because you still have the original face amount. The idea is that you're using options for your additional policy. It's not like I'm saying, all right, well, I can afford more. Now I want my 500K to be $2 million. Then that's not really the case. We're taking less, and now the company is not on the hook for, like in the reduced paid up scenario, they're not on the hook for 500K. They're on the hook for 237, which
But
they
what
basically
which
already accumulated and accrued over cost of insurance and everything else, or the cash value that's already in it. The extended term, the face amount's not going to get any higher, and you're basically have already, with the cash value in there, being paid for annual renewable term. So there's no real loss for the organization at that point.
but the
So
premium they decide means we don't have to pay out of pocket, means client doesn't have to pay premium out of pocket, but the company deciding the premium, they will decide as per the age that time or initial age.
there's no premium. They're just going to deteriorate the cash for extended term. So the cash value will slowly deplete, but you'll have that same face amount. For the example of 500K, you'd have that 500K. It's like doing a single pay on a term policy.
Mhm.
So that's basically it. There's no premium coming out of pocket. It's just a single pay using the cash that's already there.
Okay, thanks.
I have a follow-up question on that
Sure.
as well.
Go ahead.
Um, so if in these two options or these three options even, if the client's primary purpose goal is to have a higher death benefit between the reduced paid up and the extended term, they would probably pick the extended. I'm assuming the extended term would still be a higher death benefit.
Yep. it's just a gamble because now you have a time limit. So like if you were 75 and your options were this, and you had a $500,000 policy, and you pick the extended term, and it's going to last you 20 years, you're probably going to beat the system. But on the flip side is it just really depends because I always joke with people. I say, if you tell me the anticipated day you're going to die, I'll give you the perfect coverage. We obviously don't know. So if they pass that time frame, well, the reduced paid up is, much like your brother says, part of something's better than all or nothing, right?
Yeah.
So therein lies the rub. Now, we didn't talk about it yet, but there are situations where we'll examine how dividends can play into a factor here because dividends could help you not pay your premium and help you keep that face amount. So these are just what you call non-forfeiture options, or basically a last call exit strategy if needed. But we want to explore all options that are available for the customer. So in a rigid product, this does provide some flexibility because whole life is considered a very rigid product. So these are some ways to still make sure the client is okay. I did a meeting last night on an annuity case, and the lady asked me to review her policy. Now she's 62, had some heart issues, can't really qualify for insurance, but she can't pay for the premiums either. And I said, well, send me a statement, and what I'll do is I'll give you talking points on what you want to do to talk to, ironically, Bright House, or formerly MetLife. So I thought that was interesting. But we're going to look at some options for her, but it's good to know worst case scenario, you have these available if you still want to pass something on. So that's the big thing is there are exit strategies built into these.
Okay. Thanks.
Philip, I have a question.
There's a question over here with my sidekick. So what's your question?
So Philip, going back a little bit, and I'm trying to understand this when we talk about the cash value within a whole life, yes, we're able to borrow against it. At time of death and claim, what happens to that loan that you borrowed?
So the question is, you can borrow money in a whole life policy at the time of death or claim. What happens to that loan? And the answer is the same as if an IUL. If there's a loan out on the policy and there's a death, then what will happen is the tax-free death benefit will pay off the loan first, and the remainder will go to the beneficiary. So again, between cash value products, IUL and whole life, the only difference is the funding vehicle it goes into. So if your client's more conservative, whole life would make more sense. If they're okay taking more risk and aggressive, IUL makes more sense. So really that's the main difference there between the two. So now to kind of give an example here, we look at, for example's sake, the infinite banking concept. Now there is a reason why IULs don't really work in this scenario. And I'll just kind of explain how infinite banking works. Typically what happens is a client will fund a whole life policy where the major focus is on cash growth. So if we go back to those layers of cake or layers of icing on top of cake, we're trying to find the least amount of cake and the more layers of icing or more dividends. So when you talk about focus on max cash growth, you're trying to exemplify or utilize more paid up additions because you can buy paid up addition rider and have money go into that versus the base policy, and increase the value of the cash growth inside of a whole life contract. So build substantial cash over time. You can borrow against it, but here's the biggest thing. The reason why this makes sense when you call it infinite banking is there is an intention for you to repay that. Now, when we talk about tax-free retirement strategies, a lot of times people aren't paying the money back. So if you are using the wording of infinite banking and how it works, the objective is to repay that money because the loan that you have on the policy will go back into the contract. So you're actually using yourself as a bank for things like a car purchase. Real estate investments is usually the biggest one. Business funding, so you want to build a West Wing on Valor Financial Specialist home office. You would use your money and then you get a return on your own investment. 529 plans, if you want to use an alternative and use whole life, and then you use the money from the cash, but then you actually pay it back, so you can use that and gain the interest back. Or an emergency fund replacement. So again, you think about the money growing in your bank account, is nothing really if you keep it in a standard savings or checking account. So some people will utilize this as a replacement. Yes, there are costs of insurance, don't get me wrong, but it can accumulate and grow. So again, the idea is, how do you build your wealth versus building the bank's wealth? So a good example here, you want to buy a car. Let's say the out the door cost is about 30,000, so 6% per year in a 5-year note. You end up paying about 4,800 in interest. Do you want that interest to go to you, or do you want that interest to go to the bank? So the idea is how do you grow your cash from that standpoint? And the Rockefellers don't use IUL. That's because it wasn't around at the time they were here. So, but anyway, joking aside, once again, some biased people will say things to promote their product versus others. Just joking, Michael. But this is kind of how the concept works. Okay, so from that standpoint, they still don't. So let's talk about an example. Okay, I think that's what I have next on this slide. Yep. So what I'm going to do is I'm going to bring up WinFlex, and we're going to run through an example real quick here. I'm not going to do any like income designs. I just want you to see how a basic policy works. So I'm literally just going to click on an illustration, and I'm going to show you Mass Mutual because it's probably the easiest one to illustrate here. So I'm going to increase the size so everyone can see it okay. And we will go to Mass Mutual. Now you'll see they have a whole life 100. That means the whole life at 100 means it endows at 100. You have a whole life to 65, meaning it's fully paid up by 65, paid up by 20 years, 15 years, 12, 10, or 8. So they have different designs that you can pay more for to have that guarantee quicker. But we're going to just use the whole life 100 in this example, and I'm going to hit create client.
Philip, just a quick question then.
Question over here. What's up?
So if we're going to say guaranteed 10 pay, does that mean that you do your 10 pays and then they can never come back to you for a premium again?
Yep. So the question is if we did a whole life 10, if you just pay your 10 years, they'll never come back and ask for premium. The answer is yes, unless they start borrowing against it and the loan rates or whatever, if they borrow way too much. But that would be like if you have an IUL. But if it's a straight up death benefit and they don't put any more money into it, it's fully guaranteed no matter what. And everything is all said and done.
But just an example, recently I had a client that they did a 10 pay, and basically against a 10 pay, the coverage was like just 3 times their premium. So if they put in 300,000, they're getting like $1 million coverage.
Yep. So
Very expensive form of insurance, or not necessarily?
Well, so the idea of expensive is relative. So if you were 50 years old and your 10 pay was, maxed out at 300,000 for $1 million policy, the dividends will stack on top of that. So you have 30 years worth of dividends as well. So your policy will probably be about 2 to 2.5 million at time of death, because dividends are still going to stack on the policy. So that's the big thing about whole life is you'll still get dividends. Even if you pay up your policy after 10 years, you're still going to get dividends. So if we look here, we've got a 40-year-old. We're going to do a design here for a $1 million face amount. This is an all pay scenario. We're not going to do the short pays here, in respect of time. $1 million face, dividend option, as you mentioned here. There's a bunch of options, but we're going to stick with paid up additions. And then options, we're just going to keep it very plain vanilla. I'm going to keep it at annual, so no futzing around with it. The idea is, how can we look at the contracts and how can we understand how they work? Okay. So I'll just take a second here to calculate this 40-year-old individual with the $1 million policy. And again, whole life 100 means we're paying for our entire life, technically. Spito, you gonna say something? No, just put off mute. All right, come on, Mass Mutual. There we go. All right, so you'll see here the premium's about $15,770 a year. I'm going to click on the PDF here and open this bad boy up. I'm going to skip past the initial illustration here because this is the presentation illustration. I want to see how it completely works. So I'm going to go all the way down here to the money page. Left column, right column, okay? You see the phrases guaranteed, guaranteed, non-guaranteed, okay? So from this standpoint, again, as I mentioned in the beginning, I'll say again, they're different units of measurements. You're not buying dollar for dollar coverage, you're buying units of coverage. So when a whole life guy says, I'm going to give you a guaranteed 4% floor, if you're giving me a guaranteed 4% floor and I put 15,000 in, why do I have $0 in the first year? Why do I have $0 in the second year? So you should have guaranteed cash growth if it was a guaranteed 4%. So same thing with dividends. If someone says, well, I have a dividend of 8%, 10%, even 6%. Fact of the matter is that with the dividends, they also go into the calculation. So if someone says, I'm going to give you a double-digit return every single year between a floor of 4% and a 8% dividend, well, that's not 100% true. It's a different unit of measurement. So basically, the idea is that if you're talking to only whole life person and all they sell is whole life, you have to educate the client on the differences in how things are calculated. Again, it's not a bad thing. You're going to have costs of insurance, but think of that clock that we mentioned before with all the different cogs that create the whole life product. You're going to have different pieces and different cogs that are going to create this whole life product, and the dividend is part of it. The cash value, guaranteed cash value growth is part of it, but there's also COIs and other pieces to it as well. Actuarial calculation, just like IULs. So in this example here, you're going to see a line between the two, between guaranteed and non-guaranteed. The only difference is annual dividend. Now you'll see that, for example's sake, the annual dividend here in year 2 is $18.30. And $18.30 will buy you $7,047 of paid up additions. Okay, so the dividend has cash value of $18.30 as well, but it buys you a real funky number of paid up coverage. You're icing on top of the cake. So if, say, for example's sake, in year 3, the client has paid $45,000 in contract premiums, their non-forfeiture option in year 3, their total paid up insurance is basically what they put into the contract, $45,000. They can stop right there, and then it'll continue to grow over time with smaller dividends, but it will continue to grow. So again, the client has an exit strategy. But what you'll see here is the dividends should continue to increase and grow over time, which will help complement. So instead of $31,000 in guaranteed cash value, now you have cash value of $40,000. So you gain an additional $9,000 in cash value on top of what you already had in your guarantees. Fast forward down here. So a lot of times, again, if someone is trying to sell a whole life policy, they're a whole life vendor from New York Life or whatever, they might tell your client, well, hey, you can stop, this shows you have to pay for the rest of your life, but you can stop paying because the dividend should pay for the premium starting in year 10. Well, what'll happen is these pieces of cake or this icing on top of the cake will start to lop off. Okay? You'll see your face amount go from 1 million to 1,091,000. Then it'll start to dip down and it'll go down to probably back down around 1 million. And hopefully the dividends hopefully the dividends should equal the premium at that point. Otherwise, you're going to start taking loans on your guaranteed cash value, and that's how the policy can collapse. So when you look at a dividend chart, what I would say is we would analyze it consistently, and usually around, say, the 20th year, you'll see the dividend is almost equal to, if not equal to, what the client would pay. So if you want a properly structured contract where you're going to rely on the dividends, but keep it lower than a 20 pay premium, then usually around the 20th year, 21st year, a dividend should be able to make up for the cost of the premium. Should, okay? Because once again, dividends are not guaranteed, and the carrier can change the dividend scale. So what you see may not be what you get. So the big thing that you have to understand is, as people talk about whole life, if the reliance is on dividends and not the guaranteed premium, well, you are now in a non-guaranteed type product because you are relying on a non-guaranteed source to fund your product. So you just have to understand talking points or differentiation between both sides. Again, nothing wrong with this. And are dividends tried and true? Absolutely. But do you get a lower dividend if you stop paying premiums? Potentially. They have every right to change how the dividends are scaled. And when I was at MetLife, my son had a $25,000 whole life policy, and someone else has $1 million policy. Well, if 8% is the declared dividend, does that mean all policies are equal in the eyes of the carrier? Not really. So you're going to get better treatment for the higher face amounts too, comparatively speaking. So there's a lot of differences between the products. That's why to compare them and say this one sucks and this one is great, that's just an argument I don't feel like having, because it's torture. So there are benefits for both products, IUL and whole life, but you would understand that in this scenario, let's say for example's sake, I was telling the client, well, hey, we'll stop premiums at year 20. And then you come in as an IUL specialist and you see, well, hey, this policy doesn't show it stops at year 20. Well, if I had the dividends paying for it after year 20, you would see the tabular values. And then if you scroll down, there would be, it's not here because I didn't do it, but you would see a separate illustration called a supplemental values illustration, because you're changing the script on how the product works. So you have to also understand, if you're doing policy reviews for whole life, why did they buy it? Is the need still there? Are they looking more for cash? Are they looking more for death benefit? And if you can maximize and give them some type of value that makes sense for them, great, reposition. If it doesn't make sense, here's what you have, here's how long you pay for, and here are some options like the non-forfeiture options if you don't want to do that. But the hardest part is uncovering where people in whole life will try and twist the truth. So just kind of saying that, oh, you can stop paying premium at year 10, that's a problem. Just like if you do a target funded IUL and you're telling people that they can get retirement income with target funded IULs, that can be a problem too. So my goal in all of this is an education and understanding, because if you're going to skew the narrative, you're no better than anybody else. So I think the big thing is just understanding how the differences work between the companies. So, living benefits, yeah, these carriers typically do not have living benefits unless you pay for them, Aziz. So, if you have a policy where, like this Mass Mutual policy, this is just a raw, plain vanilla policy. It has terminal illness, with the major carriers, Northwestern, New York Life, Mass. You can add an LTC rider and pay for it, or you can add, some have chronic illness riders as well, so you can pay for those too. But yes, there are, if you talk IULs, yes, some carriers have it, but even in the space where it's built in is very limited. So you have a select products like Corebridge, North American, Columbus, NLG, FNG, those are the ones that have chronic, critical, and terminal. Few and far between compared to Prudential, Lincoln, John Hancock, Symetra, and the list goes on and on from the stock side, from all the other IUL carriers. So even what you're talking about with living benefits, it's a niche product or a niche product suite that not all IULs have. So if you're doing a blanket statement, you can't say, well, IULs have them, but whole life doesn't, because some IULs have them, not all of them. And it just, again, the last thing I want is for you to say a blanket statement and then someone prove you wrong, because everything else you have then is discredited, and that's the hardest part. So it's just understanding.
Yeah, I was gonna say the Emeritus whole life has living benefits, Phil.
Yeah, but the Emeritus product is a turd. I'm just kidding. So again, like I said, relative beauty is in the eye of the beholder, and there's just some people who, will lean towards a product more than another. But what's interesting is that if you, for example's sake, showed someone an IUL and a whole life, once again, everyone loves options, but if you give them 10 options, they're going to sit there and say, I'm going to have to think about this. But if you give them 2 options, maybe it's a whole life and an IUL, say this one bears the risk, because again, it depends on how the market performs and your funding strategy. So if you had a max percentage IUL 7%, well, you need to average 7% every single year for that to make sense. IUL, or for whole life, the question is do you need something that is a top shelf policy? At the end of the day, the policy is going to be there no matter what. That's where the whole life policy can make a lot of sense. So really, it just depends on what your customer is looking for in the grand scheme of things. And that's why I say, like, there are no bad products. As I always say, there's no bad products, just bad agents. You just got to really understand what's best for your customer, and to be in an open format that we're in, to allow yourself the objectivity. It's a good thing to have. So does your client want limited risk and exposure to the market fluctuation? Maybe whole life is a good conversation to have. But the big thing is that what I would say really is the only way you're going to figure this out is with a call to action here. So if you have some clients that you've never done whole life for, but maybe they were on the fence with an IUL, they thought it might be too risky, is there an opportunity for us to actually look at that together in an objective light, and see if it might make sense for your customer? And ultimately, at that point, really we can sit down and design something. And if it doesn't work, then, you still have the IUL. We can talk about talking points of that. But the big thing is, hit me up, appointments.valorfs.com, book a 60-minute Zoom, or give me a call. I think everyone on here has my number. If not,
Just to wrap up, one final
question over here.
So I've been reviewing few whole life policies lately,
Mm-hmm.
and I'm finding that clients, even after 20, 30 years, the dividends are coming nowhere close to premiums. Not
Yep.
even close.
So the question from the corner is, doing some policy reviews for clients after 20 or 30 years. The dividends are still not even close to the annual premium. once again, policies sold 80s, 90s. They had a higher dividend scale. So I'll give you a good example. So in 2008, 9, and 10, when I was at MetLife, we had a 7% dividend, and then, or 6%. I think it was 6. And I would go out and tell people, I'm like, yeah, we're at our lowest dividend ever, so maybe next year, what you see on the illustration, this should be the worst it'll ever be. And the next year is 5.5. And I was like, this is the lowest it's ever been. So it shouldn't get any lower. And then it got lower again. It got down to 5.25. And I was just like, screw it. So dividends that were proposed in the 90s were probably around 10% proposal. But there was a sliding scale for a time period when the markets weren't doing well and you saw a decline, but they can also fluctuate. It just dictates based on what the carrier provides. So that is one difference with whole life is you do rely on the carrier to dictate what is the relevant, dividend you're going to get. So, any last questions from the internets? Everyone good?
Can I pose a question, Phil?
Ah, crap. Yeah, what's up?
It's actually not for you. It's for everybody to think. Because I heard somebody mention the living benefits. And here's my question: if you're an advisor, if you're selling a product for accumulation, right, or whether it's infinite banking like a whole life, and they want to use the cash, or you're selling it, you're like it's an IUL, you're talking about retirement. How much sense does it make to have the living benefits on that policy, right? Because do you actually want to exercise those living benefits if this is a retirement plan, or
A
if
lot of
this is your
time,
bank?
yeah, a lot of time the cash, the offer that you get isn't even close to what the cash you might have in the policy is, or not a big disparity between the two. So most people will just take a loan out from the policy anyway and not exercise the living benefits if you're doing it the right way. So yeah, you raise a good point with that. I think some people, so it's
Or even
too.
an IUL, right? You're going to get a discount, and all of a sudden your whole retirement's gone if that was your plan.
Yeah, two trains of thought, and I agree with you wholeheartedly. So a lot of times people will just pay their doctor's bills with taking a loan like they were taking a LERP strategy, as opposed to cashing out their whole policy. So, but yeah, it's I think on the flip side, when you look at it, uh, usually the living benefits add maybe a 5% upcharge to the stock products. So again, I look at it as a safety parachute because some people just don't plan or want to think about planning for long-term care or heart attacks and things like that. So I think what you're comfortable might not be what everyone else is or vice versa. So that's why it goes back to objectivity. It goes back to just having these at your fingertips. And by all means, stick with your bell cows. But if you come across someone, understand and know that there are differences and opportunities out there as well. So I think that's the big thing is you're not alone and you have opportunities. So um, kind
Also,
of
a good opportunity to sell an extra critical illness policy, I think.
yeah. I mean, there are carriers that have direct critical illness policies too. So you can complement and add the two on there.
Yeah.
Shalaka, you were going to say something?
Yeah, so my question is generally what is the interest rate for the loan on those
Depends on the carrier. So Northwestern, you can always nail them because they have an 8% fixed loan rate. New York Life is usually around 5%. So it just depends. Now, the whole idea is the dividend should cover the loan. So if you took out a loan, the dividend should cover the loan interest. That's the conversation that's always had. But then you still have your premium and everything else. But I mean, there's policies that me and my cohort here have worked on where there's huge loans against them. They're still active, but so people can take loans against them, but the dividend should be basically the interest from the dividend. They should match or cover each other, kind of like a par loan, you're hoping that the S&P will cover the performance, and it's a positive cash arbitrage. Same thing with whole life and dividends covering the loan interest.
Okay.
So it varies per carrier.
Yes.
All right, guys, I'm going to wrap because it's past 5 and I need to take a nap. Just kidding. But this will be uploaded no later than tomorrow to the YouTube channel. As always, just want to say thank you guys for the opportunity. If you want to set up a time to talk, appointments.valorfs.com. Just book a time, 30, 60, phone call, Zoom, whatever. And just appreciate the opportunity to serve. Everyone have a great weekend if we don't talk. And thanks for coming. See you guys.
Thanks, Phil.
Thank you.
See ya.